good afternoon. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me is Vinny Motiwala. And for now, the market has recovered from the lowest point of the trading session. But at one point of time, there was a clear scare in the market where the Nifty had dipped below the mark of 22,000 thereabouts. And there was a sharp fall that we witnessed in the mid-cap and the small-cap indices too. But at least 22,000 is something where the bulls have fought quite well. And that's why they've managed to defend that level in the market right now. In terms of the individual names, from the frontline index, it's TCS, which is continuing to support the move. So, of course, it's off the highest point of the trading session. But after yesterday's up move, that stock has continued momentum. And the other defensives per se, your insurance companies, SBI Life, HDFC Life, these are the stocks which are actually batting for the bulls today. On the losing side, Apollo Hospitals is down, Bajaj Auto, Eicher, Maruti. So, clearly, auto is not having a great day. And we are seeing that slip in the auto index today. So, clearly, of course, it's a bit of a volatile market, but for the banking index as well, all the constituents of banking index are in the red and firmly so. Bank of Baroda down 2.25%, IDFC First Bank, AU Small Finance Bank. I mean, these are kind of moves that we expect on the day of expiry. That there are the volatiles move that happen midday, but it seems like Vinny, this has come a day before, and a lot of jagged edges across the street, and it's pretty much red.
Absolutely, pretty much red is what we're seeing coming in. But let's bring on board our technical analysts for today as well. And we have Naresh Mirani as well as Kunal Bothra joining in with us. A very good afternoon to both of you all as well. And Kunal, right now when we're seeing the charts on the screen, look at it, when it was trading in the green, and then the Nifty again saw a sharper fall coming in at one point of time when you look at the 22,200 levels. Then again it fell sharply. Then after that, after 22,050, then again a sharper fall came in. Any indication that is of sort of a market, or will we be able to sustain this 22,000 level at some point, or how is it looking like, or is this just a expiry fear kind of a thing?
It's the expiry action which is at play. Of course, rollovers being one of the key prominent points over here holds a lot of significance. We are penultimate day towards the Feb series expiry, so I think that's one major indication. But then the second factor which you also mentioned is also quite important, where the indices retest their psychological round figure numbers. Whether the Nifty retested the 22,000 levels, the Bank Nifty I think at one point was on the verge of breaking significantly below the 46,000 mark. So these are round figure strikes, and that generally gets tested on the expiry day. But the action I think has happened one day prior to the expiry for the indices, and I think that's a bit of a surprise for traders. I would believe that the two levels which I've mentioned for the indices specifically are very, very important and significant from a short-term trading perspective. 21,900, which is now fresh support for the index. So 21,875 to be precise on the spot levels for the Nifty holds a lot of important significance as a short-term trader. I think 46,000 now on closing basis could remain as a key pivot support for the Bank Nifty.
Okay, that's on the Nifty Bank Nifty resistance level 21,009. Support is actually at 21,900. That's what you're saying for the Nifty at least, Kunal. But Naresh, let's talk about where you see it moving in terms of the broader market as well, right? Because that today has started underperforming. So if you want to understand in terms of the broader market front, what is it that one should pick up from this move that we've seen? We have seen a lot of underperformance in this week, 2-3 times that broader markets have actually underperformed the benchmark indices. So what is it that one should watch out for?
So if you look at the last 10 sessions, we did hit a new all-time high on the Nifty couple of times, but did not happen the same on the small cap and the mid cap indices. And until now, it was generally the small cap indices hitting first new all-time highs and then the Nifty coming up. So underperformance has been there, and now we are seeing today the indices are down 1.5 to 2%. So that's our first indication that the momentum is waning off, and this is the time as a short-term trader one has to be careful, keep getting out wherever the stop losses are hit. So for now, the view is mid cap and small caps. There are many stocks which have overrun, and they can take a 15 to 20% knockoff from the highs. Some of them are already down 8 to 10% from the highs made recently. And there could be some more correction. So one has to be careful on the mid cap and small cap segment. Don't be in a hurry to buy the dip.
Don't be in a hurry to buy the dip. But Kunal, what's been all the more stark today is the kind of debacle that we have seen in the mid cap and the small cap space, right? And I'm sure the pain on the portfolio level is going to be much harder. In fact, as we speak, we are below 22,000 yet again.
Correct, yeah. So I think, yeah, intraday you might see the 20-30 point dip keep on happening, but I think what matters is on closing basis, and especially I think post the 315 mark, I think is where we would probably be going into a decisive angle that whether the Nifty closes with the 22,000 mark or not. But yeah, I think the pain for the mid caps and small caps was actually being felt over the last couple of days also. So at one point of time, the indices were moving up higher. They were showing signs of robust price action for themselves. The sector churn was clearly visible where the mid caps and small caps were slightly underperforming, and the large caps and more of the underperforming stocks like private sector banking names, these were the ones which are showing signs of outperformance. So I think the markets are now going back into the same tilt of maybe the mid caps and the small caps continue to underperform, and some of the private sector banking names are still holding up quite well for themselves. So I think what we need to see now is that post the sell-off, in case if the sell-off gets arrested, say in the next couple of days, is there any major sector churn, sector rotation which starts off again for the indices? We saw similar sector churn happening for the index when we saw a similar sell-off, a couple of days of correction where the private sector stocks, they started to move up higher. Then a few weeks back when we saw a sell-off of sorts, you saw the private sector banking names managing to pick up pace. So all we need to see now over the next couple of days, if in case the indices stabilize, is that whether a fresh sector churn is at play or not.
Okay, whether a fresh sector churn is at play or not is something that we should watch out for. But Naresh, when you look at it in terms of today, what is managing to just at least give some bit of a support to the markets is the Nifty IT, and when you're seeing something like a TCS, Infosys, those are the ones which are still managing to hold on to some bit of a green, at least the last time I checked it. So let's pull up TCS, Infosys as well. Both of them are managing to hold on to greens. TCS is managing to hold on to 0.5% gains. Infosys managing to hold on to 0.4% in gains. Is that something of a sort of a play that one could see coming in from the IT pack in terms of the large cap ITs now? Something that could start seeing that move coming in on the charts, and that is something we'll see a support from.
So again, out here the momentum is not great. It's been a slow and steady up move. If you look at TCS, every time it has made an uptick, then it has again drifted lower. So out here maybe this move could take it to 40 to 50 and then again drift lower. Infi, on the other hand, has not really gained in a sharp way. It's still down 15-20% from the highs made in 2021. So out here, the trend is slowly positive on the back of what is happening globally. We've seen Nasdaq 100 do well, and global IT stocks also making a bounce back. But not the best trade to be right now. So the view is very simple at this point of time when the momentum is waning off. You have just one or two stocks holding onto the index. We wait for the heavyweights. So we need to wait for a Reliance, ICICI, etc. to actually start supporting the markets. Till that point of time, we are still in this flux. And in one case where you want to keep a strict stop loss below 21,850, 900. So for now, it's a point of touch and go, wait it out.
That's a take coming in on the IT index, but time now to bring you an ET Now exclusive. Reliance Capital is going to be delisted as per Hinduja's resolution plan. My colleague Ankur Mishra is joining us with the latest detail. Hi Ankur, take it away.
Yes, Reliance Capital will be delisted from the stock exchanges as per the resolution plan which has been submitted by IndusInd International Holdings. Remember, NCLT has now approved the resolution plan, and overall plan of rupees 9,650 crore was presented to lenders, and lenders had given an approval last year itself. However, there was a twist in the tail because in the second round, when the bid was submitted by Hinduja, it was challenged by Torrent, saying that it has been submitted after the deadline. In this case, still is pending at Supreme Court. But for shareholders, as far as the resolution plan is concerned, the delisting of Reliance Capital was proposed and it was approved by the lenders. Overall, if you talk about the cash component of the resolution plan, the whole money, that is rupees 9,650 crore, is being given as cash to lenders, and hence lenders will be able to write back this amount as and when they receive from Hinduja's. All in all, it all depends on the final approval on Supreme Court itself, but for now, the resolution plan is approved.
Okay, thank you so much for that update coming in, Ankur, right now on Reliance Capital. We'll be watching out for that as well. As of now, Nifty below the 22,000 level, 21,984 is what it's trading at, down almost 1%. Let's keep an eye on that, but we'll step into a short break and be back with more updates on the market.
'Point taken. Let's take a look at the market. I beg your pardon as we're starting off this segment because the market continues to be very volatile right now. Let's take a look at what is happening at the Nifty. Is there any semblance for recovery, or we continue to see those jagged edges? No, there's actually no recovery. Whatever recovery we did see earlier is getting sold into yet again, so at the lows of the trading session. Good time then to get some sage advice from Jigar Mistry, the co-founder at Buoyant Capital, joining us. Jigar, hi. Good to be speaking with you. Very volatile time right now, and in fact for the last couple of months we have seen it's been fairly sideways for the markets. We do make fresh highs, but only marginally, and then we go into a bit of a consolidation. Is that going to be the nature of the game for the next 6 months?
Hi, Anisha. Nice talking to you as always. Thank you for inviting me to your show. Right, I think you mentioned about the past 2 months, Anisha. I think you go 2 months back, November and December, essentially, the markets rallied something like 14%. Right now, that is an occurrence so rare that it's happened only twice before after the global financial crisis. The first one was when, in 2013, when BJP looked like it will assume office. And secondly, it was post-COVID. So on a base which was fairly high, the markets rallied with the assumption that, I think two events. One, the Federal Market Committee looked like it will pivot sooner. And secondly, BJP with the three-state win looks like they'll form the government at the central stage. Now, with the second part, I think, our understanding was that it was a fairly given sort of outlook, given that they had won 224 seats, even in 2019 with more than 50% vote share. And the federal sort of FOMC, the cuts that were initially expected are now starting to sort of be given into. So in fact, if you look at the debt markets, they are now started pricing in more like, so higher for longer. And in that scenario, equity markets, one needs to sort of trade with a reasonable amount of sort of caution. We have seen a reasonable amount of rally play through, and time is now to be a little more cautious in our opinion.
More cautious is what you're saying, Jigar. Good afternoon. This is Vinny joining in the conversation as well. Jigar, when you're comparing large caps, or let's say the broader markets and the benchmark indices, how would you see that also playing out, right? At some point of time, today at least, we are seeing that underperformance coming in from the broader markets. But what's the story looking like for the broader markets versus when you look at the benchmark?
Right, Vinny. So, I think if you look at since April to January, there are some 367 companies which have more than 500 crores. So we are not really talking penny stocks. And more than 367 companies have more than doubled in share prices, 80% of which are small cap companies. Right. And I think what's happening is that even as FIIs are sort of selling on few months, buying on a few others, there is a continuous inflow of domestic capital, which a lot of mutual funds are seeing. And part of that money, I think, has been coming in from COVID, which has not really seen a massive drawdown. So I think that is one factor. The flows are outweighing the fundamentals in a vast majority. I was talking the previous point earlier. Even the BSE PSU index has rallied only since November. It's up almost 60%. So that's one point. Second point, if you look at the free float sort of market cap and not just sort of classify them as PSU or basis shareholding, then we have seen a tendency where if you actually see a very clear pattern where the lower the free float, higher the stock returns have been and higher the number of companies doubling their share price in the last 9 months. So I think there is this whole phenomenon when you combine that with the fact that a lot of new money is coming in and retail and mutual funds are the ones that own small cap. You've seen a very nifty sort of small cap rally play out. And I think I can argue that there are a lot of pockets where it's now being priced to perfection and then some more. So I think onto your point of broader market. Now, let me give you one more data points. Just in the past 1 month when Nifty, so in January, Nifty was up 0.0%, so like as flat as you can get. But if you look at BSE 500, the 20th best performing stock was up 35%. The best performing stock in BSE 500 was up 74% in just 1 month. So I think we have seen a broad basing of rally that has played out. And if at all, I think the pendulum has swung to the other side and we need to sort of brace in for impact. The only question is that, and I think that might be at the minds of everybody else as well, that what is the trigger, right? BJP looks like set to win the third term. The interest rates are benign. FIs are at their lowest holding that they have been in a decade. And they're all positive triggers. But then, historically, we have seen that when things become unsustainable, you only need superfluous reasons for them to come down. So if you remember the rally in 2017, 2018, after that, you had the long-term capital gains budget, which had grandfathered gains till Jan 2018. And then there was some mutual fund realignment, which was a flow issue, not as much as a fundamental issue. And by August 19, so from Jan 18 to August 19, there were some 47 companies which had fallen more than 80%. And there were 250 companies which had fallen more than 60%. So I think you can only manage the fund basis flows or fundamentals. I think flows are a lot more difficult to decipher given they can change anytime. SEBI asking mutual funds about their sort of free float ownership could just be the trigger. Or you can manage it through fundamentals, and things are not all hunky-dory as far as fundamentals are concerned.
Right. Jigar, just a point that you touched upon right now was a bit in terms of the PSU sides as well, right? So I want to talk a bit more on the PSU because we've seen any of the PSUs, whether you look at the defense, banking side, all these PSUs have seen a very, very sharp run up already. What is your view on the PSU side? Is that now would you be cautious on that front as well? Or, that is still something that, given that we've not seen such a run up in a very long time for PSUs, you would still look at entering something like PSUs, or they are still attractive?
Right. So see, the fact that something, if I can sort of air quote PSU and then that has entered our lexicon, that itself tells you a lot, right? Because who owns a business beyond a point should not really be that material. You could argue that, look, defense looks great and therefore you buy all defense companies, or railways look great and you buy all railway companies. But I think this whole sort of start of PSU as an investable asset class within equities is flummoxing, to say the least. Secondly, if you analyze businesses, now you look at, say, banks, for example. Very interesting because the credit costs post 2015 are so benign that one is tempted to sort of get ahead and buy the lowest valued PSU bank, assuming that their loss in market share could be as bad as it has been over the past decade. But the NIM cycle and the credit cost cycle is so much in their favor that they become good businesses. Now, in the process, few of them have actually started, the valuation discount between privates and PSUs have narrowed, but some of them have actually gone ahead and now quoting at a reasonably higher valuation than private banks. Now, I can argue on the other side saying that, look, given the fee income, given the quality of the trading book, you'll likely see a ROE for a private bank always be higher than a PSU bank of a comparable size or sort of magnitude. But then, such is the sort of time when PSU as an asset class itself is rallying. So I think we need to take a step back, look at the businesses which are underlying and not just the PSU as a theme which has been playing along. In which case, I can again sort of counter argue saying that, look, the central government spending, which has gone up from, on the capex side, has gone up from, say, 6.5 lakh crore to 11.5 lakh crore, and central governments can spend only through national highways and national railways. So those two segments do look interesting, but they look interesting not just to me, to everybody else as well, which is why the stocks have rallied so much that we could have entered a zone where you might not generate sort of phenomenal returns for the next, I would say, 5 years or so, given what you are already pricing in. So great sort of runway to grow. But when stocks go up like 10x under 2 years, you might have been pricing a lot of it as we speak, and therefore there might not be, on an equity standpoint, a lot of investable surplus to be taken, what the market is not focusing on.
Point taken. So that's the take on PSUs in the banking space specifically. But what about consumption as a basket, Jigar? Clearly, that's one space which is underperformed. And if you just go by the theme that, what has underperformed will play a bit of catch up. There is that mass recovery that people are anticipating. Affluent is already doing very well. Is there a case to increase allocation into consumption and mass consumption at that?
Right. So case to be made, assuming sort of you believe that everything is mean reverting, which over longer terms it is. But see, what we are seeing post-COVID is that there has clearly been a K-shape of recovery, not just with the economy, right? So the people who are doing good have really done very, very well. But towards the lower end of the strata, you're not really seeing that kind of gains percolate through. Now, the government has been wise enough to continue with their schemes, which means that the pain is not really felt at that level. But clearly, in the discretionary, in the sort of staples, you're not seeing the pricing power flow through very, very clearly, Anisa. So, if you look at the quarterly results that have flown by, it's hardly sort of a place where you would want to go ahead and build a reasonably large position. Now, it's not something where, because the sort of outlook is bad, those stocks are available for a song, right? Many of these businesses, your strategic foreign investors are coming in and saying, sort of, yeah, we have a valuation arbitrage. Our businesses don't trade at 50p, which our Indian subs are trading at. So, strategic stakes are being sold into a lot of these white goods slash consumption slash staple names. And until we see a broad based recovery, the rally to the top looks a little bit difficult. Now, there could very well be a place where, if you are believing that, your markets will likely correct a reasonable lot, and that's where you want to hide because they generally offer a low beta play, then that can potentially be an argument. But other than that, it's difficult to make an argument that because they've not performed, let's just go ahead and buy them.
Absolutely, this K-drama seems like is continuing in the consumption story as well. A fan of K-drama, but not this K-shaped recovery that is shaping up. Jigar, thank you so much for joining in with us this afternoon on ET Now, giving us your thoughts on different sectors as well as the markets. That was Jigar Mastry joining in with us. Nothing interesting that is happening there as well. But yes, Nifty, when you're looking at it, nothing exciting there, no sort of a recovery. Just that 21,900 levels is what it's moving at. And, let's just mark the flashes on your screen as well right now. KKR is said to be mulling to sell stake in JB Pharma. That is what is coming in from agencies. We'll be keeping an eye out on that. As of now, the stock has surely seen a fall coming in, a steeper fall on the back of this agency news flows. We will watch out for more updates on that front. But, on that note, we'll slip into a very short break. Don't go anywhere. We'll be back with more after the break. Welcome back, and you're watching Closing Trades on ET Now. Let's look at, what we're seeing in terms of the moves that has come in for Nifty Bank as well. I just want to mark that once if there's anything specific that is happening in the Nifty Bank. Nothing. It's also as much as it was trading at when we started the show as well, down almost 1% as well. But let's keep it going then with our technical analyst, Naresh, as well as Kunal. And Naresh, I'm going to come to you. Let's start with, your closing trades idea for today. What are you looking at as of now?
So looking at Tata Communications, because that's the one stock which has been holding on in the current market drift also all through the day. The stock looks pretty interesting because for the last 3 sessions, it has been doing well when the markets have not been a great momentum. So expecting this to cross new all-time highs.
Closing trade idea from Naresh. What about you, Kunal? What are the stocks that you like?
So I believe the insurance space is still looking attractive. We're discussing about SBI Life a couple of days back. So I think that stock still looks attractive, trading at 1540, 45 mark approximately. So would expect at least another 40 to 50 pointer up move for the stock over the near term. Would consider buying the stock at current levels.
Okay, Point taken. So those are the top recommendations coming in. SBI Life is something that Kunal continues to like at this point of time. But separately, let's welcome on board Anand Tandon to make sense of what's happening in the market. Anand, we understand that AMFI, which is of course the Association of Mutual Funds in India, has actually come out with a circular to its trustees of the mutual funds to protect interest of investors of small cap and mid cap schemes, indirectly cautioning them a bit with respect to the kind of froth that we are seeing in the small cap mid cap space. Would you concur with the view that small caps is getting a lot more headier?
Well, small cap has been valued higher than mid cap and large cap for quite a while now. And the biggest risk that is there in small cap is the simple fact that if and when the market turns, it's extremely difficult to get out of it. Not only do they become illiquid, but many of the ones which are their corporate governance is a bit dubious, I would say. The earnings also start to vanish as the market comes down. So in both cases, you need to be careful. That said, mutual fund managers are likely to be quite good in terms of being able to figuring out which are the ones that are worthy of investment. So I would think that while one should be putting less weight in the small cap, it is not as if you are likely to be owning a portfolio which is of poor quality.
I want to talk about a couple of names, Kunal, and that is today, obviously, Havells. We've seen that positive note that came in yesterday. Since that, Havells has been buzzing. Other than that, we are seeing even V-Guard today buzzing away in trade as well. So this consumer durable side of a sector, and seems like that's playing out. What's the view on both these on the charts? Is that an attractive time to start looking at these again?
Well, yeah, seems like maybe not an attractive time to buy, but then of course an attractive time to hold on to these names. The only reason why I would not suggest a fresh buy is because of the market scenario where there is a strong bit of a risk off. So it's bound to be that these stocks which are showing a lot of resilience today may over the next couple of days see some sort of a cool off or a mild correction. So I think buying on dips maybe a few percentage points from current levels could actually be a good strategy. But I think what we also need to see is that these are fresh breakouts which are happening for stocks like V-Guard and Havells. So Havells, over the last, I think, many months, the stock was into a broad range of consolidation. I think 1400, 1440 approximately was a huge resistance for the stock. Now it's broken past about those levels by a margin of 6-7% higher from those levels. But I would still believe that the longer term structure looks very, very attractive. So maybe not a best time to buy the stock, but I think maybe a couple of percentage points lower. Both V-Guard as well as Havells could be a very attractive buy.
V-Guard as well as Havells both look very attractive. Actually, let me toss it to Anand as well. Anand, the entire consumer durable space was a bit tepid only, despite the fact that real estate demand was quite high. We didn't see a run up in these stocks, partly because that most of these stocks are already trading at expensive valuations. What's your view now when it comes to the consumer durable and home building space?
Well, in theory, there should be an area which should do quite well, even as you said that the real estate market is doing well. However, the numbers that people have been reporting with the companies that have been reporting has not been setting the house on fire, as it were. The volume growths are muted, and consumer durable has not been one of those which has done exceedingly well in the last quarter. So there does seem to be a bit of pressure in terms of demand, and I don't see that going away currently in the context of the valuation that we're talking about, which is already very stretched. There is very little scope for error in terms of execution. So if the execution is not great and the earnings have downgrades have to be coming through, you will have a situation where these stocks are not likely to be performing very well. There can be individual stocks which one can look at, but broadly, I think this is a sector which will probably lag some of the overall market as.
Okay, so that's about the consumer durable space. Yes, in theory, they should be doing well. But what about autos as a pack? Clearly on the back foot today in the reverse gear completely. Naresh, what within the auto stock would you take this as a buying opportunity, if any?
So in terms of auto, the name I would be interested in is to look out for a dip in Maruti if it comes down back to the closer to the 10,800 to 11,100 mark. So that would be the point of time where you want to re-enter the last retest of the breakout. So the previous breakout was 11,000 from where the stock moved up recently to 11,600, 700 levels. So on dip, Maruti looks interesting because the stock has been a breakout, as well as for the last 5-6 years, the returns were nothing to be spoken of. And then Eicher Motors is something which I'm watching out for today. Got stopped out into it, but if it can sustain about 4,000, 4,040, that could be a breakout trade.
Okay, Eicher Motors, Maruti is what you're watching out for, Naresh. Anand, good afternoon. This is Vinny here as well. And, what I want to talk about, with the auto pack itself, today we did have a brokerage note that came in also from UBS, which highlighted in terms of the muted demand that we're seeing for EVs. We had seen Tata Motors actually cut the prices for its EV segment as well. What is your view on overall the auto sector, as well as where do you see especially companies that are working on the EV side? Is that something you are getting an understanding of in terms of a muted demand as well?
So, you have to look at international trends to see what's happening in EVs, because EVs is not a large part of the portfolio for most companies in India. And what you're seeing what you're talking about as a trend is something that one is witnessing globally. That suddenly there is a cutback in the enthusiasm for EVs, both from the consumer as well as the producer. And most of the companies, including Tesla, have had to reduce the price at which they are selling their vehicles. So there is a re-evaluation of how quickly the EV will work. In Indian context, there is also a further issue of infrastructure for charging. That is at least at the public level being rolled out fairly soon. So I think that still be a while before EVs will become really popular, and then probably hybrids are the place that we should look at. But as I said, the overall portfolio size, most of the companies are not dependent on the EV, and moving to hybrid should be a relatively easy bet. So EVs itself, I don't think are the ones that will move them.
So that's the take about the auto sector and the overall EV trend that we are witnessing. We did speak with a couple of experts today as well to get a sense, because there are some headlines suggesting that EVs might not be completely going off the shelf as we understand the perception to be. UBS had also actually written a note. I think UBS or Jeffries, one of them had actually written a note on the entire auto sector today talking about how not. Yes, so that was UBS talking about how not the EV sales aren't picking up as much as the street would want to believe, and that's what even Anand was referring to as well. But shifting focus in terms of the other stocks which are actually buzzing around, just taking stock of some of these big movers. So Rainbow Children's, that stock is up 10%. Force Motors has been a very curious case. We have been discussing that earlier as well. And Vodafone Idea, that stock down about 13%. Force Motors, is this a stock that you track individually, Anand, by any chance?
No, I have not been.
Okay, the reason I'm asking this is because this month itself, that stock has run up quite a bit. Let me toss it across to Kunal. Kunal, on Force Motors, what would be your recommendation? And the other one is Rainbow Children's, seeing a good amount of price volume action today.
So don't track Rainbow, so I'll skip that. But I think Force Motors, yes, I think the last 10-15 days of run up has been exceedingly high. And I think the more noteworthy part about this rally recovery for Force Motors is the strong pickup in volumes. And I think the average volumes for the stock has picked up exceptionally well, for the stock as compared to the consolidation which was going through in the good part of 2023 or the second half of 2023. So I think this generally indicates that maybe there's been a fresh way of buying into the stock price. I would probably believe that mild phases of correction. So these kind of rallies may generally not see a major retracement or a complete retracement. But even if the stock, for example, which has rallied up more than 2,000 points in the last 3 or 4 weeks, if it corrects, say by 500 to 700 points margin, which is maybe closer to a few percentage points for Force Motors, then I think that could be a good point to enter the stock.
Okay, surely keeping an eye out over there for Force Motors. That's Kunal's view there. But Anand, let's talk about, Rainbow Children's. Is that something you look at as well? And Kim's, today both these are trading at all-time high levels as well. So anything specific, you see in terms of triggers that are coming out for Kim's as well as Rainbow Children? And is that something you're looking at in the space of, the hospital sector side as well?
So hospital is definitely an area which is of interest. Largely because of the fact that there is a consolidation going on in the industry. Many of the corporate hospitals are expanding by acquisition, and it is very likely that the smaller hospitals will get squeezed out, because either you are a very small nursing home catering to a specific geography, or you have to be one of the larger chains. The in-between size is not going to be very sustainable for a variety of reasons, including costs. So from that point of view, any niche area like like Rainbow, which is focused on children, etc. I mean, especially degrees, or others which you mentioned. The space is definitely interesting. Now that said, the ROE for most of the hospitals is rather poor because the cost of setting it up actually goes up quite a bit. So you have to find means and ways of how you're going to get a proper ROE. And in that context, most of the companies have actually had a serious run up. So if you are looking at anything now, I would think that hospitals should be a part of the portfolio. But to expect that you will get immediate return, maybe you may require a lot more patience because there's already been a fairly strong upside that you have seen in the recent past.
Absolutely, but today we also managed to speak to Dr. Bhaskar Rao of Kim's Hospital as well. And, in terms of when we had point blank asked him, Manisha, in the morning about the profits of the company as well, he clearly said that, do you expect 500 crores? The simple, straightforward answer was just a yes.
Yes,
and that was,
absolutely
it was so
easily.
confident there.
I know.
There was nothing to fear about. But let's listen into his capex plans. They're coming into Karnataka, Maharashtra in terms of bed additions. What's happening on that front? Listen in.
We have been built in the last 2 decades about 4,000 beds. In these areas, we want to build next 3 years about 3,000 beds. We are already put the plan, and nearly it is costing around 2,500 to 3,000 crores of all these 3,000 beds are concerned. So we have been captured in such a way, all these funds we are going to raise through our internal accruals and as well as a part of the debt. We are very, very cautious about the debt position is concerned. We want to go up to 1:1 EBITDA and debt. Maybe some quarters we may go into 1:1.5. So we will be able to come back to normal in the next 2-3 quarters once we reach the 1:1.5. That is very, very cautious, and we have been already identified these 3,000 beds. Some of the beds are coming nearly in Andhra and Telangana, nearly 1,500 beds. Another 1,500 beds we are going into the other states like Maharashtra and Karnataka and Tamil Nadu. So that is the plan for the next 2-3 years. So by the time in the next 3 to 4 years, we will be around 7,000 beds. Then once we consolidate these 7,000 beds and we see what we have been achieved and what we are planning to achieve, if we are successful in the same page, then the next expansion for after 3 years will be a little bigger than what we are doing today.
Okay, so that's the commentary coming in from management of Kim's. But on the losing side, you have Vodafone Idea down 15% as we speak. Z Entertainment is also fairly volatile. Both of these are the trader favorite stocks which keep on seeing heavy volumes today as well. They're trading with good amount of volumes, but the move is on the downside clearly. Motilal Oswal as well as PNC Infratech are some of the other names which are reeling in the red. But from the frontline index itself, apart from Infosys, TCS and maybe an HUL and Bharti Airtel, most of the stocks are actually trading in the red. So the market breadth is clearly very skewed towards decline right now. And take a look at Reliance, a cut of 2.5%. That itself is good enough to kind of break down the Nifty, which we're seeing right now as well. It's going below the mark of 21,900. But Kunal, comment on the chart checks of Reliance as well as ICICI Bank. Heavy selling on both the counters today.
Yeah, I think Reliance is something interesting because, yesterday for the first time the stock had broken past about the 3,000 levels.
Yeah.
And, today the stock is sub the 2,900 mark, at least in the last couple of minutes, the stock was sub the 2,900 levels. So these are very extreme kind of reactions for a stock like Reliance Industries. Now, more importantly, when I look at the charts, today's low with the stock has hit, that's sub the 2,900 mark, is almost like a 14-day swing low for Reliance Industries. So imagine it took 14 days for the stock to move from 2,900 towards 3,000 odd levels, and just one single day the stock has reversed the gains for itself. So that's generally an indication that the market, or the stock is going through a bit of a chop and churn kind of a price action. In this kind of a scenario, what we ideally do is we try and look out for more higher ranged, supports as well as resistances for the stock price. I think the more prominent support now for Reliance Industries should be the starting point of this rally, which is closer to 2,820, 2,840 mark for the stock on the spot levels. And on the upside, I think the 3,000, 3,005 levels, which it hit yesterday, I think that should be taken as a minor resistance of sort.
Right, Anand, I want to talk about a specific sector that, we've seen a lot of move coming in this month was in terms of the realty space as well, and the realty pack. They've overall seen a very good move coming in, obviously given the push that is there in terms of the construction side, infra side as well. Anything that you find very attractive that you would look at the realty pack, or maybe do you think in the realty sector there's already, everything is priced in now, and this is where we would see it holding on to?
So unless the market collapses very dramatically, I would think that the demand for realty will continue, at least on terms of housing, will continue for a while. The challenges, if any, are likely to be on the commercial real estate because, with work for home, etc., becoming a trend. You find that globally also that there is a lot of, for example, in the US, there is a lot of commercial real estate which is coming up for renting and the prices have collapsed. And we also know what's been happening in China. So, of course, the China problem is a little more debt oriented, whereas the US is demand oriented. So, in India, if you were to look at it, I think housing still remains something which is fairly attractive. To a large extent, it's a function of how much funding is available. And while housing finance companies are an easier way to play reality and perhaps in a more sustainable way, you could have bought some of the real estate companies. My own favorite way of playing sector is actually to buy housing finance companies. I think that still remains a good trade.
Okay, point taken. Let's just bring on board the small cap and the mid cap index and see what kind of movement that we are seeing right now there, because the headline index is down 1.25%. It's a much deeper cut for small cap index, almost above the mark of 2%, and for mid caps as well. Let's take a look as to what the cut is. It is again over 2%. So clear underperformance coming in from the mid cap and small cap space, and part of the reason is that ANFI, notice that went to the trustees as well of mutual fund, wherein they have asked the mutual funds to be cognizant of the risks which are there in the mid cap and the small cap space and take care of the investor interest there and take proactive actions to protect the investors, which could be in several forms, which could of course be protecting them from the first mover advantage of redeeming investors, to moderating inflows, portfolio rebalancing. So these are some of the measures that they have asked the MF trustees to use, and we've recently already seen a couple of these mutual funds stop their inflows into small cap category, right? It was Kotak recently that stopped it. There were others as well, ICICI Pru, Birla MF, etc. They have been a bit vocal about how large caps is the space to be right now versus the mid cap, and that's something that we are witnessing as a reaction in the stock prices today as well, because there's that nervousness that there'll be additional curbs or limitations per se in the inflows to the small cap and mid cap, and the kind of froth that we have seen might get a bit more calibrated, and that's the reason these indices are at the lowest point of the trading session. Naresh, if I had to ask you, in terms of the risk reward purely, let's look at the four major indices: Nifty, Nifty Bank, Mid Cap and the Small Cap. I know the trading isn't as deep in the broader market indices as the front line, but clearly in terms of risk reward, which is best placed and which is worst placed?
So best placed is the Nifty itself, because there's a basket of stocks and not every stock or sector is breaking down in the Nifty itself. So that's where it is. But we are very close to the stop loss. We are getting back testing to that 21,850, 900 mark. So there are times where you don't want to do anything, wait out for a day or two. So we are currently in that time where you're getting stopped out on the indices, the trade on the bank Nifty and the Nifty, you've got stopped out, and now you need to wait it out rather than do anything. So for now, the trade is to do nothing.
Taken. So that's a view coming in as far as the mid cap and small cap indices are concerned. But just shifting focus in terms of the other big movers in the market right now. Infosys, TCS, these are holding one end of the market, so that's the good news coming in. But from the broader markets as well, there are some pharma names also which are perking up, apart from, of course, the hospital names as well. But fintechs and these, platform companies per se, Anand, that's something that we have been watching out for as well closely. Policy Bazaar has been doing well. Delivery has come back on the radar of investors, and we saw a good amount of buying happening there. Paytm, of course, was in the so-called value zone. In the benefit of hindsight tells us that today as well that stock is a bit lower. But how should the retail investors approach this entire fintech and class of 21 IPO group as a whole?
You don't necessarily have to buy everything that's in the market. If you're looking for something which is a more balanced portfolio, like one of your analysts earlier recommended, the life insurance space is something which is quite good. There is a reason why PB FinTech is doing well. They are also leveraging off the same trend, though they are not the life insurance company itself. So to some extent, some of these trends are very long-term trends, and therefore, dips should be used as an opportunity to buy. On the fintech space, where you are trying to get into payment banks and all that, some of that is actually very volatile. Retail investors should really leave it out for the professional one. That said, there is a case to be made now, perhaps that Paytm will not do as badly, and from here also you should be able to see a movement upwards in terms of profitability. We are not talking about the stock price, and therefore there could be a case for holding on to it at some level. But my own view is that if you are looking at something with the regulator and the like, you don't know how things will pan out. So it's much better as an investor to not play the themes which are unknown, but rather deal with those which you know, and therefore are able to make a more sensible view of how they will pan out and what will be the trend for me. So necessarily, it's not a best idea to take adventurous positions, especially in a market which is showing some signs of it.
Right, Anand, thank you so much for joining in with us this afternoon, as well as giving us an understanding in terms of the markets, individual stock moves, as well as sector-wise as well. Thank you so much, Anand, for joining in with us. But Nifty at the day's lowest point as of now. Kunal, the 21,900 seems to be nearing your support level right now.
Yeah.
But what is your BTST trade for today? What is it that you are watching out for?
So two buy calls I will still go with for the mid-cap segment, and one of them would be City Union Bank. That stock is actually looking more like more on the recovery side. So I would probably expect the stock to get back into a recovery phase from here on. So would look out for targets in the range of 146. Stop loss could be tailed to closer to 130. MedPlus is the other name. It's an interesting chart. The stock had been beaten down significantly over the last, I think, 6 to 7 months or so. But I think on the daily charts, it's now forming a bullish flag formation. So a breakout above 700 could be very positive for the stock over the near term. Targets of 740 and stop loss at 680.
Okay, and Naresh, your BTST trades for today?
So first is a buy on Tatacom with a stop loss at 1900 and a target price of 1970. Second is a sell on Bajaj Auto, which has given the first indications of a breakdown. So stop loss at 82.20 and a target price of 8,000.
Those are the bets coming in on from Kunal as well as Naresh. Nifty as of now 21,900. Kunal, is there any sort of worry that we should be, if it manages to support, then there's not a worry. But if it falls below that, then how much of a fall can one see in this?
So the level is very crucial, 875. It was the previous, 3 days back, 4 days back, when the indices had seen a sharp selling pressure. It was from 875 that the Nifty had taken a support. And from there, we saw almost a 300-400 point rally for the Nifty, coming closer to 22,300 mark also at one point of time. So on the way down, if the index breaks this support, then we could be looking at a 500 pointer cut on the index coming by. So which means that what we are seeing today, if in case this support level gets breached, we could be looking at least another 2% correction for the index over the very short term, and that's why I think it's a very, very important level to watch out for.
Okay, very, very important support level over there. But thank you so much, Naresh, as well as Kunal, also for joining in with us. And with that, let's wind down what is happening in the markets as well. As of now, Nifty closing at the day's lowest point, 21,923 levels is what it is at, down 1.24%, fallen 270 points more than that from this day point as well, from the day's highest point as well. Sensex to 72,250 levels is what it's managing around as well. Broader markets, that's where we have seen a sharper fall today coming in, whether the Nifty Midcap or the Nifty Smallcap, both have seen a very, very sharp fall. Cuts of more than 2% is what it's closing at. Reliance too under pressure today and down more than 1.5%, approximately around those levels as well. 1.9% is what Reliance is closing at as well. Let's pull up something like a Tata Motors, Eicher Motors, where are they closing at, as well as Bajaj Auto. Those were the names that that we saw some bit of a move coming in terms of a downfall for Bajaj Auto as well. Where we saw some bit of a green today was in terms of Havells, Max Financials, as well as Samvardhana Motherson, which managed to hold on to gains. Other than that, in terms of sector-wise, nothing exciting that we can see in terms of a move. Nifty IT, that's where some bit of a support that came in today from was the Nifty IT pack, and in that, especially when you talk about it, TCS as Infosys was something that managed to hold on to green for the Nifty IT. Other than that, what is managing to close at all-time high levels is the Rainbow, Children's Hospital, V-Guard, Aster TM, as well as Kims. And in terms of the top losers that we've seen today, we do have Vodafone Ida that was clearly under pressure, Z Entertainment, Godrej Properties, K Fintech in the mid and small cap side, which have seen clear pressure coming in as well. So yes, that's how the market seemed like was looking at as well. In terms of overall Nifty 50, we have Apollo Hospitals that was clearly under pressure today, as well as Ultratech Cement as well. Nothing exciting that happened there. And Bharti Airtel, something that managed to hold on to a bit of a green today from that side, as well as Tata Consumers. But with that, we're absolutely out of time on this edition of Closing Trades. It's a goodbye from Anisha, myself, as well as the team who put this show together.